At this point, you're probably tired of hearing the government printing too much money and the inflation monster is just around the corner. Not to mention, it wouldn't be complete if we don't hear from an economist saying we're going to get a crash of the century. And then the year it finally does, they'll be screaming, "I told you so." This is what Warren Buffett has to say about investors listening to economists who don't make a lot of money in the markets.
All of these economists with 160 IQs that spend their life studying it, can you name me one super wealthy economist that's ever made money out of securities? You know, I mean, just go down the list. No, Keynes actually, in his early years, tried to make money in stocks by predicting what business would do, and he gave it up. And then he went over to a Graham-type approach. I mean, it's very interesting to read his history on this, because he thought he could, by looking at various economic variables, pick what he called the credit cycle and make a lot of money. And he went broke a couple times in doing it, had to borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments. And he did very well. It's an interesting history. But if you look at the whole history of them, you know, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
At the end of the day, what happens in the short term in the markets is completely out of my control. But what is in my control is how I allocate my capital, especially to great businesses. So the question is, in a low and rising inflation environment, what asset classes will help grow my own wealth? According to JP Morgan, where they looked at 1988 to 2020, there was 4 periods where there was a low and rising inflation environment. And it turns out that REITs is one of the asset classes that have performed pretty well historically. So in this video, I want to share my learnings on REITs with you, along with the REITs on my watch list as well. And let me get the boring stuff out of the way. No, this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. REITs stand for Real Estate Investment Trust, and the whole idea is really simple. Take investors' money, invest it in a portfolio of diversified real estate assets, and then distribute all of the rental income to the investors. That is really it. The 2 ways REITs make money is either via rental income or capital appreciation on the real estate assets. The rental income in REITs will generally grow by a certain percentage every single year, and that percentage is determined by the tenant and the landlord. Sometimes that percentage can also be the consumer price index plus a certain percentage. The rental income growth on its own can be considered as an inflation hedge, and the capital appreciation is just icing on the cake, in my opinion. Now for REITs to enter my watch list, these are my filters. First, great tenants. This is just like renting your house to someone else. You would like someone who are making money on a regular basis and they're not suddenly going to default on their payments or take ages to pay their rent. Secondly, the WALE needs to be greater than 5 years. And WALE stands for weighted average lease expiry. What that essentially means is that the average tenant agreement is greater than 5 years, which almost guarantees income from that tenant over that period of time. And thirdly, I like my REITs to have some kind of essential element to them. So it doesn't really matter whether the market is booming or crashing, we'll still have to use those real estate assets. Fourthly, I like to see the REIT grow their operating income, because at the end of the day, that operating income will pay your dividends. And finally, the debt to equity ratio needs to be less than 0.6. The number 0.6 is a little bit arbitrary, but taking a chapter from the global financial crisis, I just don't want any REITs that are leveraged up to their eyeballs. So as it stands, I have 2 REITs on my watch list and 1 property group. Now the first REIT on my watch list is the Charter Hall Long WALE REIT. As of recording the video, they were trading at $4.70 with a 2.69 billion market cap. They do have a dividend yield of 5.67%, but take that dividend yield with a massive grain of salt, because as the share price change, that dividend yield will fluctuate. So the whole idea of this REIT is long WALE. The weighted average lease expiry on this REIT is 14 years. And the occupancy is 97.5%. Now it did drop from 99% to 97.5%, and that's because this REIT did own the previous Virgin Australia's headquarters. The portfolio of assets is also quite diverse. You have 14% in telco exchanges, 25% in industrial and logistics, which is like 2 thumbs up for me, and 33% in long WALE retail. So long WALE retail are BP stations or Bunnings warehouses. And normally I am honestly not that keen for office real estate, but it turns out that a lot of the tenants are ASX blue chip companies or government tenants. So I kept digging. Now, just going back to my criteria, long WALE tick, majority of the assets do have an essential element to it. So majority of them are a tick, but there are a few pubs in that long WALE retail here, which is kind of not that exciting in my opinion. If we take a look at the major tenants, majority of them are blue chip companies, and there's a big portion of Australian government agencies. So I really don't expect them to default on their payments or be slow to their payments either. At the same time, I'll do more work to look at the future prospects of these companies individually, just to make sure they're here to stay and they are more than capable to pay their rent in the future. If we take a look at their financial performance compared to the same period last year, they have grown their operating earnings by 41%. At the same time, I am very aware that majority of this growth came from higher number of properties. But regardless, earnings growth, check for me. When it comes to their balance sheet, the light blue bar is net debt, and then the gray bar is total equity. If you do the calculation, their net debt to equity ratio is about 0.3. So definitely not leverage up to their eyeballs, and debt to equity, check for me as well. The next REIT on my watch list is the Centuria Industrial REIT. As of recording this video, they were trading at $3.11 with a 1.72 billion market cap. They do have a dividend yield of approximately 5.59%, but again, please take the dividend yield with a massive grain of salt. So taking a look at the portfolio of assets, these are all essential pieces of infrastructure in our economy. For example, manufacturing, distribution, transport, data centers, and cold storage. On top of that, they do have some great tenants inside these real estate pieces as well, with the exception of Aussie Post, because they seem to never deliver the parcels to my buildings anymore. It just always seems to go straight to the post office, which is like super annoying. So going back to my criteria, essential element check and great tenants check. Again, when it comes to their financials, their operating earnings have grown from 30 million to 42 million, which is great to see. But it's also really good to look at multiple periods instead of just looking at one. But in this case, earnings growth, check for me. Similar to the long WALE REIT, majority of the operating earnings growth came from higher number of assets. And the WALE is about 9.8 years, which have grown from 7.2 years compared to FY20. Together with a net debt to equity ratio of 0.43, so long WALE, check, and net debt to equity ratio less than 0.6, check as well. The last one I have for you is not exactly a REIT, but more of a property group, and that's Goodman Group. As of recording this video, they're trading at $17.26 with a 31 billion market cap. They do have a 1.5% dividend yield, but again, please take that with a massive grain of salt. Now, majority of Goodman Group's real estate assets are industrial related. So these could be Amazon's fulfillment centers or data centers. Now, the good thing about Goodman Group is that they have assets across the world, but their WALE have decreased from 4.7 to 4.4 years. So they technically don't tick that long WALE box. But because of their industrial focused real estate portfolio, not to mention geographic diversification, I have given myself a bit of a pass on the long WALE side, but they definitely check the essential element when it comes to real estate assets. If we take a look at Goodman's top 20 global customers, I think it's fair to say that most of them will probably not default anytime soon, and they will be considered as great tenants. So great tenants, in my opinion, check. If we take a look at the financial results, Goodman Group have grown their operating earnings compared to the same period last year by about 15%. And as a result, their earnings per share have also grown as well. But you're probably wondering how come their operating profits have grown, their EPS have grown, but they are not increasing the distribution per security to their shareholders. Because Goodman Group is not classified as a REIT, they don't have to pay out majority of their earnings to their shareholders, which gives them a lot of room to allocate capital to development or buying new assets. And taking a look at their balance sheet, they have very little net debt. So earnings growth, check, and net debt to equity ratio less than 0.6, check as well. Those are my learnings about REITs so far, and my framework of thinking is still very much a work in progress. And I do want to acknowledge that yes, these are just options in Australia and we're not bound by that. There are plenty of different options in Singapore, there's plenty of different options in US as well. But hopefully this video have helped you understand my thinking process when it comes to REITs and how I filter out companies that go into my watch list. Just a very quick portfolio update. As of recording this video, my CMC market portfolio side of things is worth about 86,000 Australian dollars, and I've made no changes to this side of the portfolio. For my stake portfolio, it's worth about 37,000 US dollars, which is give or take approximately 47,000 Australian dollars. And I've made no changes on this side. Dropbox and GoPro are free stocks that's given to me if you do decide to try stake for yourself. And no, I am not sponsored. Now, at the end of the day, I still have $1,700 I need to allocate. So when I do allocate that capital, I'll keep you posted in my portfolio updates. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.